So, fighting a trade war with China is always messy, and this is something the Trump administration has to realize. It's not a straightforward affair. You threaten trade tariffs, you threaten financial sanctions, and most of the time they will comply. However, trying to use these tactics on China simply won't work. It will hurt the Chinese economy, but it won't be big enough to bring the system down. Now, take trade tariffs for example. Trump slapped an additional 20% on Chinese exports and most recently another 34%. But how exposed is China's economy to US trade actions? These are China's biggest exports to the US consumer market. The biggest category is consumer electronics, with nearly 100 billion exported in 2023. However, that's only 22% of China's total exports. Going down the list, from machinery to EV batteries and appliances, one trend is very apparent. Chinese exporters sell more to the world combined versus the United States. Cutting off Chinese imports will hurt American consumers more. People will suffer higher inflation at a time when interest rates are still sky high. And this just puts the US economy closer and closer towards a recession. Now, since Trump's first trade war, China saw the writing on the wall. Biden blocking EV and solar imports just confirmed their fears. So they started to retreat from the US consumer market. China is no longer dependent on the United States to drive growth, and this is very important. The Chinese leadership mandate comes from a stable society tied to economic growth, and that can't falter. In 2018, exports to the US accounted for 3.5% of China's GDP, but in 2023, this is less than 2.9%, a big change in a very short period of time. And in 2025, we can expect this dependence to drop even further. It could easily fall under 2% if Trump decides to go extreme with this trade war. Now, China is no longer afraid. It's a big reason why they are confident enough to dump all their treasury bonds and cut off critical exports to the US economy. And now, they have dealt another major blow. Beijing has now blocked Chinese companies from investing in the United States. And if you're a local company in Shanghai or Shenzhen, you can no longer invest in US firms. The government has reportedly blocked registrations and approvals for investments into American companies. This isn't good for the US that needs foreign capital to flow into their businesses. Trump wants to reshore industries back home and for domestic companies to build factories within the United States. But this is a tall order, especially when his trade war is backfiring on American revenues. As an American CEO, raising investment money is based on hard realities on the ground. Companies think logically and not based on emotion. Just because Trump wants you to build a new plant in Nevada doesn't mean you click your heels and immediately agree. You have to look at economic growth, which is a bellwether of US consumer strength. But Trump's policies are crushing the prospects of US growth. The Fed themselves expects US GDP growth to collapse in Q1 this year. They are forecasting an overall contraction in the economy of 3.7%. That's a huge decline considering growth last year was positive 2.8%. As a company, you would be terrified of pouring money in today when the economy is about to fall by over 6% tomorrow. Fighting a trade war with China isn't like playing checkers. There's a reason why Beijing isn't hitting the US with big trade tariffs. They have many other levers to pull that doesn't require them to hurt their own consumers. Now, restricting investments into the US economy is a very big card they can play, and it ranks up there with export controls and telling their insurance companies to shift away from US assets. Over the last 5 years, China has been dropping their investments into the United States. The environment there is just too hostile and uncertain for them. Last year, China invested only $7.1 billion into the US, but Q4's total was horrendous, only $200 million of investment. If Trump continues his trade war, this amount could fall to zero. This shouldn't be a surprise. Consider the pitfalls. The cost of production in the United States is higher, and there's no guarantee that the consumer class there will continue to grow. Now, throw in the threat of political risk and potential confiscation. Getting China to invest in the United States is like swimming with the sharks. Sooner or later, you will get eaten. Because of this, US companies looking to expand have less capital to work with, especially if more countries follows China's example and simply walk away. They will have to issue bonds at over 6% or go to the private debt markets and take a loan there. However, it won't be cheap. According to the ratings agency Moody's, US corporates are at enormous risk of default. Over the last 4 years, the average risk of default for US public companies has more than doubled to 9.2%. It's worse than the 2020 pandemic levels. Furthermore, these are listed firms. How much worse is the situation for private companies? It might be well into the double digits. If foreign direct investment continues to fall, Trump won't get his industrial renaissance. There'll be no rebirth of US production because companies simply can't afford to raise money for domestic investment. Trump is making a very big gamble, a very big play here. He's betting that tariffs will shift the flow of investments from the rest of the world into the United States by raising an insanely high trade barrier. Trump hopes to frighten companies, both domestic and foreign, into building new plants in America.
Many yesterday, General Motors was in. They want to invest $60 billion. The people from Facebook were in yesterday. They're going to invest $60 billion by the end of the year. Other people are talking about numbers. Apple, as you know, a few days ago announced $500 billion investment. They're going to build their plants in the United States, which, as you know, almost all of their plants are in China. Now they're building in the United States. Look, the reason is two things. Number one, the election, November 5th, and the other thing is tariffs. I think probably in that order.
So companies like GM, Facebook, and Apple will invest hundreds of billions in the United States. Now, sounds impressive, but is it really? How much of this amount is new spending? Now, much of which are already existing projects already planned for, especially during this AI race. Can you also imagine how much an iPhone will cost if it's built in the United States? Something made for $1,000 before will now cost 2,000, 3,000, or even 4 grand. Companies could see their profits evaporate if the tariffs get really brutal, which they have. The average tariff level in the United States is around 7%. Now, it used to be under 3%, but the number has risen since Trump started his trade war. Should he go pedal to the metal, we could see a worst case scenario take shape. The average tariff rate could rise to nearly 35%, which would be the highest level since forever, much greater than the smooth Hawley period in the early 1900s. Once again, the majority of tariffs will be paid by either the consumer or the importers. Both outcomes are still bad for domestic US companies. Either their profit margins collapse or Americans simply stop spending, and that ultimately leads to a revenue crash, which might be even worse. How is that going to entice more companies to invest? It isn't. Corporations are guided by earnings. They follow where the money is going to be. Remember the Wayne Gretzky quote, "You skate to where the puck is going to be and not where it currently is." Now, sure, the US consumer market might be the biggest today, but there's no guarantee it will remain that way. Consumption might ultimately drop. And whether Trump likes it or not, he's pushing the US economy towards the cliff of a recession. And this causes economic uncertainty to soar to the moon, and we aren't even joking. During the first trade war, the Federal Reserve discovered the obvious: the higher the uncertainty around US trade policy, the less companies will invest and hire. Why would you take the risk when the entire system could implode tomorrow? And ever since Trump won the election, his Crazy Man Act has flipped everything on its head. Trade uncertainty has reached an all-time high. It's more than double the panic compared to the first trade war and supply chains breaking down during the 2020 lockdowns. Companies, both domestic and foreign, they don't have a clear guideline on how to proceed. Trump could remove all tariffs today and reimpose and double the punishments tomorrow. Who really knows? China restricting investments is most definitely a bargaining chip. Decoupling is not gonna stop, but Beijing wants an edge in the trade negotiations. Now, Trump's idea of weaponizing the US consumer market is going to backfire very badly. The only way for him to get investment dollars into the US during a trade war means other countries have to lose. Money flowing into the United States means capital that's being denied elsewhere. Just think about it. If German companies build a factory in Michigan, that's a factory not being built in Wolfsburg. For over 2 decades, the US economy has relied on a ton of foreign direct investments. In fact, the majority came from their G7 allies, including Japan, Canada, Germany, and the UK, more than $2 or $3 trillion in total. Japan alone invested nearly 800 billion into the US economy, and that created a ton of manufacturing jobs, helped to drive innovation, and contribute to GDP growth. Now, all that could be lost. The Japanese are now moving closer to China because of Trump's trade war. That's how fast the situation is devolving for the United States. These countries don't want to deindustrialize their own economies to build a new factory in Nevada or Illinois. It's not a long term solution. It will just make them even more dependent on the US. Now, things are so desperate that even Europe is starting to push back on the United States. Trump has managed to get even the European Union to stand their ground.
But my message to you today is that we have everything we need to protect our people and our prosperity. We have the largest single market in the world. We have the strength to negotiate. We have the power to push back. And the people of Europe should know that together we will always promote and defend our interests and our values, and together we will always stand up for our Europe.
Besides counter tariffs, the EU could always cut investment dollars into the US as well. Many countries, especially Germany, invest a ton into the United States. And if this money stops flowing, the US economy will be in deep trouble, especially when Trump is trying to cut down on government spending and the federal deficit. So there's no way for them to raise money for new subsidies or incentives. Investment money flows into economies that are growing, especially those that are increasing their national spending. And guess what? China is doing that in spades. China's central bank has pledged to deploy big amounts of stimulus if Trump goes crazy with his trade war. And Beijing has many tools to deploy than just dropping interest rates. So far, Beijing has not fired the bazooka yet. The overall stimulus in December and January hardly reached 1 trillion yuan or $200 billion in either month. Because China's inflation is so low, they have the ability to use two big facilities to flood their economy with liquidity. They can use their lending facility or reverse repo to add cash into the system. Reverse repo to buy debt from Chinese banks and issue cash, while their lending facility to issue direct loans to the banking system. In addition to that, China can always issue more government bonds and the PBOC can buy them. Yes, that is quantitative easing QE, but China can afford it because their bond yields are much lower than US treasuries. And we are in a trade war after all. Once we understand this, China blocking investments into the US makes a lot of sense. They are putting a ton of pressure on the US economy that is trapped from their debt and deficit crisis. China's stimulus is not just a defensive tool, it is now an offensive weapon to drain investment dollars away from the US. And this is going to put even more strain on corporate earnings. Remember Costco begging Chinese suppliers to eat the tariffs? Well, Walmart is back at it. We have new reports that the retailer is asking Chinese exporters to cut prices by as much as 10% for each round of tariffs, which basically means to shoulder all of Trump's import taxes. Apart from how ridiculous it sounds, it tells you how desperate things are. They know the US consumer is weak, and neither do they want to take a hit to their earnings. So Trump's economy is at the breaking point. His trade war has real consequences, and China is turning up the heat. This is a multi-pronged approach to force the US to negotiate. The Trump administration might not have such a strong hand after all. China is not out of cards just yet. But let me know what you think. Will China retaliate even further? And can Trump really bring more foreign investments into the US? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.